the U.S., where they are right back to drill, baby, drill. They are going absolutely crazy in the Permian Basin. You are not seeing a great increase in sustaining capital expenditure in Canada. One place that one might look to benefit, I'm probably giving too much credit for Canadian politicians. They're probably incapable. The largest and potentially lowest cost producer of potash is Russia. Real estate measured in gold is cheap. I think not holding gold is irresponsible.
Rick Rule, financial analyst, investor, speculator, and founder of Rule Investment Media. It is a true pleasure to host you on Palisades Gold Radio today.
My pleasure. I've enjoyed the conversations with Palisade Gold for a long time.
Excellent, Rick. Us as well, of course. Now, the commodity landscape has shifted drastically since the last time we spoke in early January, of course, on the back of the war in the Middle East. And today, Rick, I'm very excited to get your long-term and fundamentally driven outlook on the commodity complex. And perhaps we should start with energy, actually. When we look at your assessment of oil and gas supply, how much supply is truly being disrupted? And with WTI futures currently trading around $90 to $95 a barrel, are markets too complacent?
I think markets may be too complacent, but I need to say energy is a very complex topic. I remember the last time you and I talked, and I was able to say, because nobody liked oil and gas stocks, that oil and gas was a no-brainer. I, of course, wasn't prescient enough to have anticipated war. That's not what I do. But I noted that on a global basis, the world was underinvesting about $1 billion a day in sustaining capital investments. And I suggested to you that the oil price could easily be $90 a barrel in 2029. It turned out that the war front-loaded that move. And that's why things are complex. It's important to note that if the war goes on, the price levels that you're seeing today are anticipatory, which is to say that the oil market has moved up from 65 to 90, well, higher than that for a while, in anticipation of a shortage. The world hasn't really experienced a shortage yet because of floating inventory and strategic reserves. If the war goes on for 2 or 3 more weeks, then you will see what happens if you have to ration oil by price. I'm not suggesting that the war will or won't go on. That's above my pay grade. Neither the Iranians, nor the Israelis, nor President Trump have me on their speed dial. So I have no way of telling you how this conflict is going to end. Here's what I can tell you. The headlines will have you believe, and it's true, that 20% of the world's crude flows through the Gates of Hormuz. The more troubling number is that well over 50% of the world's export crude flows through those same straits. If you are in the United States and Canada, mostly if you're in the Western Hemisphere, you have less of a challenge because there are ample North American supplies. But if you are particularly on the eastern rim of the Pacific Basin, you have some real problems. And it's worthy to note that the WTI market, which is commonly quoted at $95 a barrel, is a futures price. Cargoes that are loaded today on tankers that are south of the Straits of Hormuz are commanding as much as a $40 a barrel premium, which is to say the futures market at $95 doesn't correspond well with a tanker loading in Pakistan or Sri Lanka at 140 or 145 a barrel. People need to understand that. For people who are short-term, who are traders, who bought oil in anticipation of the gradual rise in oil prices, they may want to trim some. They've had a hell of a move. And you never know what's going to happen in 2 or 3 weeks. But I would suggest not to trim all. In the event, as I say, that this circumstance isn't resolved quickly, the price gets uglier very quickly if you have to ration by price.
Incredibly interesting, Rick. Now, you mentioned this 2 to 3 week time frame where we might see rationing in the form of price, as you outlined. What would happen to oil supply globally if the war were to end tomorrow? Flow would continue to the Strait of Hormuz. How much supply is already being disrupted through that? And will we see shortages just on the back of that?
As I understand it, in the near term, there are 200 tankers north of the Straits of Hormuz that can't get out. There's a fair bit of supply there. And I suspect that the anticipation of disruption would fall and the reality of disruption would be different. the United States administration has already taken the unusual step of anticipatory desanctioning of Russian crude. So I would suspect that if the war ended, you would see a fairly rapid decline in oil prices. I need to say, though, that the circumstance that caused me to be an oil stock buyer, which had nothing to do with the war, which had everything to do with the systematic underinvestment in sustaining capital, hasn't changed. In fact, the destruction of productive capacity in the Gulf, both in terms of the Qatari liquefied natural gas infrastructure and the Iranian infrastructure on Karg Island, will take as much as 5 years to fix. So the real problem around oil supply, which was systematic underinvestment, has accelerated as opposed to decreased. So while in the very near term, which is to say 2026, you see some relaxation in price, the circumstance that we talked about 9 months ago for late 2028, 2029 gets exacerbated. Most people, even commodity investors, don't think in the 2 to 5 year time frame, which is why most commodity investors don't make money.
Rick, are there any historical parallels for the amount of supply that is at risk here if this war were to continue for the next 2 to 3 years? Is there any historical parallel we can glean from?
Yeah, the Arab oil embargo in the early part of the decade of the 70s. This wasn't war related. Well, I guess it was war related. If you remember the Israeli conflicts with virtually all of their neighbors. But it was a political act, really, in response to that so greatly disrupted oil trade. It's worthy to know that, again, decades of underinvestment combined with the constriction of supplies from the Persian Gulf was, and I need to add back inflation, partially responsible for a move over the decade of the 70s of the crude oil quote from $3 a barrel to 30. That was, in fact, a prolonged move. And I'm not suggesting that a move on that order of magnitude is present. But I am suggesting to you that irrespective of the war, the circumstance that we're facing in late 2028, 2029 is very real and has merely gotten worse.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades, Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. And when we look at the oil equities, what price would you say they are currently pricing into their valuations, and would you say they are fairly attractively priced?
It depends on the oil and gas equities with regards to that. There isn't one size fits all. I suspect that and I don't know. The honest answer is I don't know. I haven't done that work. I do know that there is a lot of anticipatory pricing both in the oil price and the price of oil equities. And one might rationally expect that all of the oil equities, with, of course, the exception of Aramco, which is now publicly traded, the Saudi company, could be expected to fall in price upon, if it occurs, reasonable resolution of that problem. This would be, in my own opinion, the calm before the storm. I'm hoping for a resolution of the conflict for a whole bunch of reasons that have nothing to do with my portfolio and everything to do with the future of humankind. But a resolution of the conflict and declining oil prices would put the oil stocks probably back into the hated category, which is where I want to see them because I'd like to buy more. I know the inevitability of production shortfalls later in this decade, and I'd love to take continued advantage of it. This has been very inconvenient for me in that the easiest allocation decision I had to make in 2026 became much more complicated with that war.
Would you say there's still opportunities to be found if you're willing to do dework, for example, thinking about Norwegian producers, as you know, LNG infrastructure has been destroyed in the Middle East. That seems to have a very long delay until it can be rebuilt, even in a, no war going forward scenario. Those producers might benefit disproportionately.
The Scandinavian producers are interesting in the sense that the geological endowment in Scandinavia is spectacular. And there is still at least the vestige of the rule of law. The challenge that you have is that Scandinavian governments traditionally, although they've enjoyed spending the social rents from energy, have been anti-energy. And that is a challenge. I note that the Lundin family, who cut their teeth in the Norwegian offshore, many people don't know that Adolf Lundin began his career working for Norsk Hydro. When, after 50 years of trying, they scored a big field in the Norwegian North Sea, $1 billion net, 1 billion barrels, net to their interest, sold it, which I think tells you a lot about the return expectations that Scandinavians have with regards to Scandinavian energy.
All right, well understood. What about North American producers that have a lot of undeveloped inventory laying around? If this war were to prolong, those players could, ramp up drilling and through that ramp up production rapidly.
That is happening. When I talk about the deferral of sustaining capital investment around the world, I am leaving out the U.S., where they are right back to drill, baby, drill. They are going absolutely crazy in the Permian Basin, which is why you're seeing the Henry Hub gas price fall so quickly. The byproduct gas in the Permian Basin, byproduct as a consequence of being co-produced with oil, is overwhelming the infrastructure. And that sustaining capital dearth is not occurring in Texas. It's very worth noting, however, that the Canadian companies are taking their surplus cash flow and either paying down debt, not a bad thing, or returning it to shareholders. You are not seeing a great increase in sustaining capital expenditure in Canada, which I suspect is a consequence of the political leadership in Canada, who, despite their kind words to the contrary, have proven to be continually anti-oil and gas. So in that circumstance, you aren't seeing benefit. One place that one might look to benefit would be Woodside. The LNG potential of the Northwest Shelf in Australia and the development of that Northwest Shelf of Australia has opened up a real alternative source of supply for East Asia. So prolific, in fact, that ironically, a ship of liquefied natural gas from Australia landed in Atlantic Canada. Why the Canadians couldn't figure out the business case for supplying natural gas to Eastern Canada and instead chose to import it from Australia is one of the political absurdities of the world. I collect absurdities.
And Rick, thinking about the producers that you or a viewer at home might already own, how do you think about taking profits off the table, as this geopolitical event continues?
I struggle with that. As a speculator, my primary goal is to capture the move in a commodity from hated to tolerated or liked. And the oil equities have in 1 year gone from hated to loved. The speculator in me should be selling my basket of Canadian oil stocks because they did what I wanted them to do, but they did it 3 years too early. The greedy part of me says, why not hang on and see what happens in the Persian Gulf when 3 years from now the pricing levels that you had expected are going to occur anyway? I suspect that I might be punished for straying from my basic discipline. I have no particular interest in selling my Exxon, as an example. It's a machine. But the basket of Canadians that I bought, partly as a consequence of speculation, if I were a rational actor, I would probably be selling half. In this particular case, I'm a hopeful, not rational actor. I'm hoping that the circumstance in the Middle East gives the political leadership of Canada the courage to allow the building out of Canadian infrastructure and kickstarts that economy with a latent asset that isn't active. I'm probably giving too much credit for Canadian politicians. They're probably incapable of rising to the moment. but I'd like to believe that they're capable of it. I'm very fond of that country and its people, and very, very fond of the resource inventory. So I haven't sold any yet.
Right, and I guess a hard part also of selling oil and gas equities is we are nowhere close to an inflation-adjusted all-time high in oil, so harder to really start offloading the producers.
Well, remembering, I mean, what you say is absolutely correct, and that's exacerbated by the fact that we're underinvesting $1 billion a day, and that has real consequences. I mean, it has real consequences. If you aren't recompleting wells, if you aren't drilling makeup wells, if you aren't replacing and repairing infrastructure, your ability to produce declines. If you look at the example of PDVSA, the Venezuelan national oil company, with the largest reserves in the world, their production's declined by 85% as a consequence of deferred sustaining capital investments. This will come to bite us. And the other thing is, as you say, the fact that oil in inflation-adjusted terms is cheap. And the fact that sustaining capital deferred today needs to be replaced 3 years from now in a cost environment where, as a consequence of inflation, the input costs are rising between 5 and 8% a year, compounded, which is to say $1 billion deferred today likely costs you $1.2 billion to $1.3 billion to make 3 years from now, after you've already experienced the production declines, when it's more difficult to make that investment. The dilemma, of course, that the Venezuelans and the Mexicans are facing is that 2 decades of underinvestment and 2 decades of input inflation have coalesced. They have less free cash flow to invest because their production's off 85%. They have billions of dollars of investment to make up, and they're having to make it up on an inflation-adjusted basis, which they're simply unable to do.
Rick, how are you analyzing the other commodities that are being disrupted by this war in the Middle East? For example, LNG, and we can talk about fertilizers, helium. Is there anything that catches your eye there?
Helium is interesting. I recently made a helium investment. With Qatar, the world was truly awash in helium. It's important to know that. But that party came to a screeching halt. To the extent that one were going to speculate on helium, there's such a dearth of vehicles, it's very difficult to do. Helium, of course, is a natural gas. It is simplistically formed by the breakdown of uranium. And so you would look for sedimentary horizons that were adjacent to large historical sources of uranium, which suggests that a wonderful place to look for helium would be Saskatchewan in Canada or Kazakhstan. But finding a pure play is difficult. Traditionally, the biggest source of supply in the U.S. has always been the Hugoton embayment, the northern up-dip extension of the Anadarko Basin. That has produced for so long and produced so much gas it's under pressurized. It's becoming an increasingly difficult place to attract helium. This is probably the province of investors and speculators who are more sophisticated than the average ones. The probability of making mistakes is high. The impact on the helium market of the resumption of Qatari supply, if it occurs, are high too. Liquefied natural gas is probably a better place to look, a bigger, broader market with more participants. Less sophistication is required. Look for supply. Look for installed capacity, which is to say capacity that doesn't need to be built. It's already built. And look for what you would look for in any oil and gas investment, which is to say high returns on capital employed, high deliverability, high operating margins. One looks immediately to Woodside in Australia. One perhaps looks to the increasing liquefied natural gas export infrastructure in Canada. But the big player in liquefied natural gas is the U.S. And U.S. supplies are increasing. And to be honest with you, the margins that Permian Basin producers are making with regards to oil means that their lifting cost of gas are sub-zero. They have to lift the gas to get the oil. And for them, the challenge is actually to make the gas go away. So to the extent that one is attracted to that, you might look at Devon. If you have the courage of a lousy balance sheet, you might look to Occidental And you might, if you want a purer play, look to Cheniere, which has been a pioneer in LNG infrastructure construction in the U.S.
With gold trading at new all-time highs, gold producers are printing money. And this means that for the first time in years, money is beginning to flow into exploration. This is a trend that we at Palisades Goldcorp have long anticipated, which is why we spent the last decade assembling the largest junior-held mineral claim package in the United States through our subsidiary Made in America Goldcorp. Made in America Goldcorp holds over 700 square kilometers of prospective ground, located exclusively within America's most prolific gold mining trend, the Battle Mountain Eureka trend. Made in America's properties are nestled amongst several of Nevada's largest gold mines and resources, making it highly prospective for a potential discovery. To find out more, visit palisades.ca and join us on our mission to make Nevada's next multi-million ounce gold discovery. Now, back to the show. I would love to take you back to helium for just a second. How does that space typically work? I mean, in mining, of course, you need to explore for it, invest hundreds of millions, if not billions of dollars into developing a mine, while in oil and gas, you drill a well for a couple of million, and you could be a producer from that point onwards. Where does helium fit into that, roadmap-wise of going from exploration into production?
Helium's in the middle. You have to drill out enough of it that you can afford to put in extraction infrastructure. In other words, you have to strip the helium from the other gases present. I don't suspect that we will have a challenge if we start looking for helium, finding it. As I say, my favorite conceptual place to look for it would be on the skirts of the Athabasca Basin in Saskatchewan. The initial industry work there has been pretty prolific, but there's an awful lot of work that needs to be done. And I don't know if they can attract the capital that they need to do it, given the fact that the Qataris will have a sustainable competitive advantage should Qatari capacity be restored. Beyond Saskatchewan, I would suspect that good places to look would be South Texas, along the Frio Trend, where there's substantial in situ uranium mineralization, and probably Kazakhstan, where there are substantial sedimentary basins which have also been proven to hold large amounts of uranium. But this is a long-term and capital-intensive project. I have no doubt that if the Straits of Hormuz continue to be closed, that within 2 years we will have drilled out sufficient helium that we will know where our supplies come from. I can't tell you before that drilling has occurred where those supplies will come from, but I guess my bet would be Saskatchewan.
Well understood. I would love to talk about fertilizers and agriculture for a second. On the back of this war, we've seen urea, a type of fertilizer, skyrocket in price, up almost double. Some of the others, like potash and phosphates, seem to have lagged. Do you think that's an interesting opportunity to go for the other ones that aren't directly disrupted, but could still benefit?
They could. I think that you need to regard that as speculative because you're looking at macro circumstances that neither you nor I can control. The Gulf gas producers have a durable competitive advantage in nitrogenous fertilizers, given the abundance of feedstock and the incredible amount of fixed capital they have in place. To the extent that the Gulf comes offline, the world's going to have disruption in the liquid nitrogen business, the urea business, nitrogenous fertilizer business for a long time. It will be a problem that can be addressed with other sources of natural gas, but it will be difficult to attract the capital to develop that source of natural gas because all the people writing the checks know that the second the Gulf comes back onto production, they are sitting on what are only marginally economic reserves. A second problem happens in the potash business. The largest and potentially lowest cost producers of potash, well, the largest and potentially lowest cost producer of potash is Russia, far and away. And the Russians have not come anywhere close to making the sustaining capital and new project investments necessary to exploit their potash because they've had other uses for money. In a word, the Ukraine. And there are some constraints on the export of Russian nutrients for that reason. Once again, if sanity returns to the world, and peace were to break out between Russia and the Ukraine, there would be challenges for every potash producer in the world, with the exception of, again, the Saskatchewan potash producers, who are not, to be sure, competitive with the Russians, but they beat the hell out of everybody else in the world. A distant third would be Belarus, which has also not made the requisite new project and sustaining capital investments. If the global geopolitical situation doesn't sort itself out, the big winners will be the Saskatchewan producers. They're in second place. There's lots of scope to expand production. While they will not be as cheap as the Russians, they are much, much, much cheaper than anybody else. And it's a jurisdiction that, for the most part, has the advantage of the rule of law. Phosphates are becoming interesting. If there was ever political disruption in Morocco, something I don't see, I see Morocco as a country that's improving, you would have challenges around phosphate. The phosphate boom in the southeastern part of the U.S., Florida, South Carolina, the southeastern seaboard, that's pretty well played out. There's no way that the United States will resume its former glory as a phosphate producer, and that crown, I think, has moved pretty decidedly to Morocco, but time will tell. The idea of being a long-term investor in nutrients is a good thing. There are 8 billion people on Earth. This is basically a GDP story. As poor people become less poor, one of the first things that happens is they increase their per capita consumption of calories. One of the great things we've done as a species in the last 40 years is we've moved 2 billion people away from being desperately poor to being very poor. We have 1 billion people to go. We'll accomplish that in the next 20 years. More people will eat more. And without the green revolution, which is to say without modern diammonium phosphate and those forms of fertilizer, we can't feed 8 billion people. It's as simple as that. So demand is built into demographics, but one needs to be a very long-term investor to take advantage of that. I'm delighted to say that I have been invested in the nutrient business for 25 years. And while it's exposed me to an awful lot of cyclical rises and falls and an awful lot of volatility too, if you look back over 20 years, 25 years, my return on capital employed on a compounded basis has been superb. The slow growth nature of the business has been that a lot of the return that I've enjoyed has been current return in the form of dividends. And so I suspect that my real return has been higher because I've reinvested those dividends without ascribing that benefit to the share price of the stocks in my portfolio.
Is there a short list of names where you would start researching?
Yeah, I'd probably start with Nutrien. If you have the ability, and I don't know if you will, but my European listeners, as an example, who live in Switzerland, should probably consider the Russian producers. If they're speculators, they are the low-cost producers because I'm regulated by U.S. banking regulators, and I don't want to run afoul of the U.S. State Department. I am inactive in Russia right now, much to my chagrin.
Excellent, Rick. Talking about gold for a second, what role do you think it should fulfill in a portfolio? Oftentimes people attribute it to the role of a safe haven. Has it been playing that role the last few weeks during this conflict?
I don't think that one measures safe haven in weeks. I began systematically saving it. Well, I began to pretend to systematically save in gold in the 70s, except for I was more of an investor and a speculator than I was a saver. From the time I developed a lot of surplus capital, which was the beginning of this millennium, I began to systematically save in gold and maintain liquidity in US dollars. And my experience in the last 26 years now has been instructive. Gold has generated almost a 9% internal rate of return annually in my portfolio, which is to say it has kept pace with pricing levels. When I, as I do, informally look at my income expressed in gold, my assets expressed in gold and my costs expressed in gold, I'm surprised at how cheap things are. Real estate measured in gold is cheap. Food measured in gold is pathetically cheap. Health insurance and health care measured in gold are cheap. When by contrast I measure them in US dollars, all of those things are frightfully expensive. That tells you gold's true role. The recent decline in the gold price tells you something else ironically positive about gold. It was a source of liquidity in times of need. The Turks in particular needed to sell, believed they needed to sell their gold to defend their currency, to keep politically expedient domestic pricing low. And they were able to do that. Had the Turks gone to the global bond market and tried to borrow any currency in the world, but particularly Turkish lira, they would have been singularly unsuccessful, given the fact that they had 60 tons of gold to sell and sold it. They weathered the storm. And there's a real lesson there. Gold has spectacular liquidity, 24/7 in any markets. You may know, you can see my logo. I'm the founding shareholder of a bank, Battle Bank. And one of our premise is that we love to lend against gold as a piece of collateral. We love to lend against that collateral because we can perfect and sell that collateral if somebody didn't pay us back anytime, 24/7, in any quantity. It's really unique in that regard. It would seem to be a substance that maintains, in a real sense, its purchasing power. And it's also uniform and insanely liquid. It's volatile in price in the near term. But if you look at any other asset that you have in your portfolio, they're volatile too. If you look at currencies, various different currencies, and you measure them against a basket or against each other, they're volatile. If you want to see real volatility, look at your home. Have your home appraised by 3 different appraisers, and you will find at the same minute of the same day that the price of your home, according to a non-market transaction, which is to say an expert, varies by as much as 10% per second, depending on the valuer. So I think this is going to sound trite. I think including gold in one's savings portfolio is simply a matter of sanity. I don't think that there's an excuse for not holding it. Whether or not gold is an investment class or a speculative class depends more on the investor. But as a savings class, a savings or insurance class, I think not holding gold is irresponsible.
Simply a matter of sanity. This example that you gave of Turkey selling a significant amount of their gold holdings is very interesting. Luke Groman has been making an argument on X of these Gulf countries that effectively are getting an enormous liquidity crunch, significantly less income from oil revenues, higher expenditures as a government. Therefore, they might sell what they could get their hands off. Do you think this is a headwind we should account for with gold over the next few weeks to months potentially?
I guess it depends on your outlook. I own a lot of gold, and a financial planner would look at me as the largest shareholder in Sprott, in effect a financial services brand name for gold, and that planner would say, Rick, you are crazy owning gold. You don't need any gold. But I'm an old man. Gold allows me to sleep nights and stay calm. My gold isn't for sale at this price, so I would like to see it cheaper. Where people who are speculators and investors are afraid the gold price might fall, those of us who are savers are hoping the gold price falls. Given that a move in the gold price from 4,600 to 4,700 or 4,800 would not benefit me because I wouldn't sell, I would prefer to see gold fall $400 or $500, in which case I would be a buyer, as opposed to go up $400 or $500, in which case I wouldn't be a seller. So I really think it depends on your perspective. I hope, not for the benefit of citizens of these Middle East countries, but for my own benefit, I hope the gold price falls.
Were you a buyer recently when gold dipped from about 5,500 to 4,300?
I was a buyer in January when I sold 80% of my physical silver. I had that silver in a speculative account. In other words, the role it played for me was speculation. And when silver went from hated to loved, when there was that parabolic up move, I sold 80% of my silver. And I put 25% of the sales proceeds into savings, which is to say I put it in gold. If I generate more liquidity, I likely will continue to overweight gold relative to short-term U.S. cash, which is my other savings vehicle.
How do you think about silver currently? Of course, since you made that call in early January, silver had an incredibly skyrocketing process upwards and a significant fall following quickly after. Is it again attractive right now?
Not for me, not as a speculator. I believe the next 10 years will unfortunately be good for the gold price. I say unfortunately because circumstances that are good for the gold price are usually bad for credit markets, and credit markets are where people live. And I suspect that over the course of 10 years that silver will outpace gold. I have always regarded for my own portfolio, and this is always personal, silver to be a speculative asset. And there are other asset classes within speculation that I prefer to silver. So for me personally, unless we return to a situation which we saw 4.5 years ago, when I was first interviewing with Palisades Gold, where silver was hated, I wouldn't be a buyer. I remember 4.5 years ago, after the aborted silver squeeze, silver below $20 an ounce, and I remember looking at the internet discussion groups where 9 out of 10 commenters on gold were hugely negative, hugely negative. I love circumstances like that. I love circumstances where a commodity for which there's ongoing demand experiences rank hatred. There's nothing in the world I like as a speculator more than hate. And so until and unless we saw that circumstance back in the silver market, which I don't anticipate we'll see for 12 or 15 years, I won't be a silver speculator. I will note that if we dial ourselves way, way back in history, probably before you were born, 1975, in the midst of that wonderful bull market, 1970 to 1980, where the silver price ran from $1.50 to $50. I mean, a truly remarkable run. In the middle of that, the early part of 1975, the gold and silver prices both fell by half. And there was a 5 or 6 month period where in the midst of that just spectacular bull market, that silver returned to being hated again. So I wouldn't rule out a situation where, as a response to higher interest rates probably in the U.S., if that occurred, that both the gold and the silver price would be derailed temporarily and would experience real hate. Certainly in 1975, there was widespread hate of gold and silver, particularly among the people who were new adherents to it in 1974 and got high-sided. And if that occurred, I might return silver to my portfolio in a speculative place.
Rick, in your search for utter hatred, is there any commodity currently that fits that bill?
Sadly, no. We have run out of hate. The only hate that is expressed in the market right now is geographic. There are places in the world that are still hated, mercifully for me. The one that I would most like to take advantage of, Russia, I can't because of political constraints both in Russia and the United States. But there are other parts of the world that are hated. If I were still a real estate speculator, I would be in Dubai and Abu Dhabi and Qatar in a flash. There's nothing that engenders fear quite so much as war. Probably, were I allowed, I've tried to do this for 30 years without success, probably I would look to invest in Iran. Certainly a hated place with evident risk. But the truth is that Western investors are overly concerned, I think, about the political risks in a lot of places that they can't pronounce or spell, mostly because of ignorance. I'm not suggesting that those places aren't risky. I'm just suggesting to you that they are not as risky relative to the U.S. and Canada as they're priced, which is to say I think the U.S. and Canada are more risky than people give them credit for being. I think Scandinavia is riskier than people give it for credit for being. And so when I look at the relative risk between Sudan and Congo and Brazil and Indonesia relative to Europe and North America, I'm attracted to the risk-reward parameters. In fact, the only classification of oil companies that I'm still actively trying to buy are conventional explorers. The world likes the shale plays. Offshore, the world likes onshore. In frontier and emerging markets, places that other people can't spell. Unfortunately for me, the shares of those companies, which were really in the dumpster in November and December, are up 30 or 35% as a consequence of a higher oil price. And so right now, my bids for them are unrequited love.
What about precious metals miners? Do you still own a significant stake in those? And if so, where would you say the value proposition is currently at?
A lot. I own a lot. When I sold my silver, noted that the silver miners were priced on Wall Street and Bay Street using an approximate $45 per ounce price of silver, which is $75 seemed too cheap. So half of the money that I raised selling my silver, I put into the silver miners. The arithmetic to me was if the silver price kept going up, that the miners would go up with the silver price. If the silver price went sideways, by definition, I'd make no money on the silver, but the silver miners were priced at $45, so I could still make substantial profits in the silver miners. And paradoxically, if the silver price fell, that there was some shelter in the silver price as a consequence of the fact that the equity prices were discounting $45 silver in a $75 world. That circumstance exists today. In the gold markets, I'm of two minds. My instinct tells me that over 10 years, the beta in the gold market, I would define beta as the difference between the performance of gold equities relative to other equities, will be significant and substantial. And part of me says at my age, when I ought to be retired, that I should confine my activities to the biggest and best companies, the Francos, the Wheatons, the Agnico Eagles, because I think they're going to do spectacularly well with relatively little company risk. But the valuations of those companies relative to the best of the best in the other sectors are high. And an investor like me who is patient and disciplined and educated should be coming down the quality trail. If he is a he, pardon me, I was a Californian there for a minute. If he is a he, should be looking as an example at single asset producers, which are viewed rightly by the market as more risky than multi-asset producers, but the discount goes away if they get taken over. I mean, immediately. The whole circumstance that we're seeing in the gold equities chain is that the larger producers have more liquidity, more trading volume, and higher share prices, and the rest don't. If value arbitrageurs don't come tighten the spreads between the big companies and the small companies, the market will. The big companies will take over the small companies. I think we're going to have an M&A streak in mining. Witness the recent G-Min takeover of G2 at a 72% premium, yet still accretive. That'll tell you how much room there is in the next 3 years in the gold mining space. In terms of expressing that, mercifully for me, I expressed it 4 years ago, 5 years ago. And if you looked at my own portfolio in an allocation sense, you would see a gross over allocation to gold. So I don't need to go deeper into the space.
You can just continue to rotate. Well understood. Some would argue the juniors have moved less than you would expect, actually, with how much move we have seen in the underlying commodities of gold and silver. Do you think there's a credence to that? And does that mean that there's indeed a catch-up value investment to be had, like you outlined there earlier?
Sadly, you're asking me very good and very nuanced questions. I prefer dumber questions, but let me try. I will start by saying that if you merge every junior gold explorer in the world into one company, Junior Explorco, that company would lose about $2 billion a year. So what should you pay for that company? 10 times losses, 12 times losses? In a bull market, maybe 15 times losses? The point is that the junior mining industry is always overcapitalized because as an industry as a whole, it's worth nothing. It's worth less than nothing. It destroys capital. That belies the fact that the best 10% of juniors generate so much value that they add legitimacy and even luster to a sector that loses between $2 and $5 billion a year. So it's a stock picker's game. The overall junior market is hopelessly overcapitalized. I mean, hopelessly overcapitalized. It's probably 1,500 companies worldwide, and there's probably 200 that are viable. Now, that doesn't mean that in an increasing gold price, that the Vancouver used car salesman won't be able to, tweet stuff out about amalgamated moose pasture and how the gold price is going to go up. And it doesn't mean that those shares won't do well. But in terms of the juxtaposition between price and value, the only way that you can afford to speculate in that game is by really learning a lot about the underlying value of the assets, doing the work. You may know that I've graded now over 35 years almost 100,000 portfolios. And I've learned an awful lot about the mistake that individual speculators make. Much too narrative oriented, much too lazy, own way more stocks than they can follow, much too impatient, not tenacious enough, making money in junior explorers, which is one of the sort of roots of my own portfolio, involves doing a lot of work. It involves holding for 5 or 6 year time frames during which the individual equities can fall 50% in price or more without derailing the value story. Most speculators aren't willing to do that. And the consequence of that is that most speculators, if they did an honest self-assessment, wouldn't, or at least shouldn't, speculate in the junior sector. For those of us who do, it could be a truly, truly, truly wonderful place, as my own portfolio testifies.
So you mentioned earlier, single asset producers very attractive place to be looking for value arbitrages compared to majors. What about developers? Are they still trading at attractive prices if you compare it to NAV?
I wouldn't like to suggest that all developers are equal. There are developers, as an example, who are amalgamators. Let's call them Bay Street developers, more financial jockeys like myself than engineers. And participating in their game is very, very risky. It could work, but it's very risky. What you look for in a developer is track record, and track record around specific expertise. G Mining is an example, the people who just took over G2. The Gignac family has been involved as mine builders and contractors for 40 years. And they have developed a subspecialty in constructing gold mines in orogenic settings in tropical, remote locations with high rainfall. Well, guess how they built G Mining? They built high-quality gold mines in orogenic environments, in tropical, high rainfall environments. In other words, they stuck to what they did. The consequence of that is that the stock is up tenfold in 3.5 years and is still, from my point of view, undervalued. So when you say developers, there is not a one-size-fits-all answer to your question. Certain developers, the people who have access to capital, who know what they're doing, and are sticking to their regional and deposit expertise, can be expected to do very, very, very well. The Bay Street Cowboys, ultimately always round trip. The stock goes up and the stock goes down. And that process of falling is a lot less pleasant if you're long than the process of it going up.
Rick, this has been incredibly insightful once again. I would love for you to talk about your conference as well as the rankings that you do.
Well, let's do the rankings first. I have over 35 years ranked for free, almost 100,000 portfolios. If your listeners have liked what I have to say, if they haven't found me too cynical, or even if they have, and they'd like to access my expertise on a personal level for free, they can do that. Go to Rule Investment Media. That's one of my websites, ruleinvestmentmedia.com, and list your natural resource stocks. Please, no crypto. Please, no tech stocks. Please, no pot stocks. I do natural resources only. But if you go there and list your stocks, I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments might have value. And that's all free. Note I'm working very hard, so I'm 5 or 6 days behind. So be patient after you submit your stocks for rankings. As to the conference, we have now for 30 years put on what I consider to be the finest natural resources investment conference on the planet. Period, full stop. Why is it the best? Well, great macro experts, not the kind who parrot what you hear on BBC or CBC or Fox, but rather people who give you a view of the world as it is, rather than the way the big thinkers wish it were. Armed with that knowledge, we bring to you analysts and portfolio managers who've made money on natural resources for 40 years, through bull markets and bear markets, nuanced thinkers, not newsletter writers who've been in business for a year and a half during a bull market and think they know it all, but rather people who have stood the test of time. Every public company and exhibitor at our conference is owned by the conference sponsors. No guarantee, I'm afraid, because I own a stock that it goes up, but there is a guarantee that we have vetted those companies. The qualification to exhibit at every other conference I know is a check that cashes, which is not a very stout test. Finally, unlike any other investment conference on the planet, by the way, we're sold out physically. So to come to the conference, you can only come online via live stream. 2 things that you need to know there. The first thing is that we'll give you more content in 48 hours than you can, in 4 days, over 48 hours than you can absorb. So we'll make the tapes available, and you'll have to use them. Don't think of this as a 4-day commitment. Think of it as an 8 to 12-day commitment over a year. Small price to pay to succeed in your portfolio. And here's where I make it worth your while. If for any reason at all, your choice, that you think I didn't deliver the value, I'll refund you your money. The financial risk is all mine. There is no other investment conference I know that makes you an unconditional money-back guarantee. We have offered that guarantee in every education product that we have sold for the last 30 years. And I'm very proud to say that we have had to refund less than 0.1% of the tuitions that we've charged over 30 years. But that guarantee is your guarantee that we know our content is of high enough quality that you will benefit from buying it.
Rick, thank you so much for your generosity with your time and insights today. I really appreciate it.
Thank you for the opportunity. I've enjoyed these sessions with Palisade Gold and yourself these many years.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CDAR Plus at www.cdarplus.ca.